Hello everyone and welcome to the Like a Tortoise channel. Before I dive into today's video, I want to say a big shout out to all of you guys who've been commenting the videos. I'm so glad to when I went through the comments the other day and I noticed that many of you are leaving positive comments. You guys are finding the content educational, insightful, and it goes to show that what I'm teaching here is creating value, some form of value in your lives, and I do expect that continue to be the case going forward. And I will definitely encourage me to put out more content like this one. So yeah, thank you to all of you, and let's discuss today's video. And so, in conversation with one of my clients the other day, I think. And also based on some of the content, some of the comments that you guys left in some videos about valuation metrics and so forth, I think it's very important to discuss this matter. Before buying any company, you really have to know the value of that business, right? Because price is what you pay and value is what you get. And so many market participants, as the famous Philip Fisher once said, they know the price of everything, but the value of nothing. And look, granted, there are different in investing strategies, but I really think that unlike other investors, for example, the so-called quality investors, much of our framework is similar, but I really think price should carry heavier weight. And the reason for that is because ideally, you would want to own a business for the very long term. And that means 5, 10 years, even longer. But the problem is, no matter how great the business is, if you pay a really high price, well, even if you pay, say, a PE of 30 or 25, that means the business would have to grow attractively over the next few years. And you are not factoring in any margin of safety, in my opinion, because you have to account for possible recessions, for competition, all right? So especially if you are running a concentrated portfolio, the price that you pay for companies will matter, and it will matter significantly. And so in today's video, I want to show you some of the things that I've been preparing over the last hour, just to show you how important that is, okay? And let's start with one of our portfolio holdings, which is PayPal, which you already know. By the way, I have nothing to hide here. So you can see that I started this portfolio in January 2024. That's almost 2 years old, and you can see that the rate of return is about 56%, 57.56%. That's about 28 annualized returns so far. I'm not sure whether this outperformance will continue, but I do expect it to continue because number one, we own higher quality businesses compared to the average S&P 500, and number two, they are priced cheaply, right? So they are priced cheaper compared to the S&P 500. So it makes sense for the outperformance to continue, okay? And for those of you who are not aware, here are the positions in this portfolio, okay? Alibaba being the largest holding, and Ulta Beauty being the one that comes right at the bottom of the portfolio, not because I didn't want to buy more, okay? I wanted to buy more. This was just a starting position, but unfortunately, it just exploded right after I bought the initial share, and I wouldn't chase it because I honestly don't feel any FOMO. I felt FOMO initially, but now it's just I'm happy if you end up making money chasing a really high flying tech name. That's okay. I'm happy for you. I don't feel any FOMO really. But I want to talk, so let's use PayPal here as an example. And why I want to use PayPal is because, and I already have this prepared for you here in Stock and Lock, is that some of you guys, hopefully none of the viewers on this channel had the unfortunate were unfortunate enough to buy PayPal when it was trading at such crazy high valuations back in 2019 in 2020. But if this serves as an important reminder that again, price is what you pay, value is what you get. All right. And so, and it's important never to chase price. So look, this is true. This is the actual earnings per share of PayPal since 2019. And you can see that from 2019 to 2025, PayPal has compounded earnings per share at about 15% per year. Guys, that's incredible. For a company to grow earnings 15% per year, that's great. It means they are doubling their earnings per share, right, every 5 years, every 4 to 5 years, which is exactly our minimum acceptable rate of return. And so this in itself is already very sound growth. But look what happens. Look what happened back in 2019. In 2019, some people were paying a PE of 55.56. Yeah, and the price was about 150. And then in 2020, it got to 190. So you were paying 53 times earnings. And even in 2021, which was crazy exuberance when PayPal got to its all-time high, you were paying almost $310 per share, and that led to a PE of 87. Now, fast forward to today, 2025, and you can see that the price is still sitting at 66, is now at $67 per share, and we have a PE of about 14.42. And this despite all this earnings per share growth. So what do I mean by that? What I mean by that is that even if you change the PE, let's say we use a PE of 17, which is more realistic based on the earnings per share growth over the last 6 years. But even if you do that, you can see that the price will be, let me just multiply this here. Even if you do that, the price will still be around 79. And so you will still be underwater. If we change the PE to 20, that you are still underwater. If we change the PE to 21, you are still underwater. If we change it to 23, you are still underwater. So for you guys to make money, the P would need to be at least, it need to be 25 so that the price would be around 116. And that means anyway that you would have made no return. You are just at break even at this point. Okay, even with a P of 25, and even considering all the earnings per share growth throughout this period. So it's not that PayPal all of a sudden became a shitty company, which justified the incredible crash. No, what happened here is that the price got so detached from fundamentals that, eventually when sentiment shift, okay, then the price collapsed. And sooner or later, what you will see over the very long term is that price will always follow the evolution of the company's earnings per share, right? They can get detached every now and then, but over the very long term, they tend to move quite in tandem. And that's why it's important that you pay a fair, what I call, I like to pay cheap price, but you pay a fair price. And fair price, in my opinion, doesn't mean to say you should pay 25 times earnings or 30, because those are high multiples. And I understand that some companies deserve to be trading at a premium compared to others. But because I'm conservative with my money, and I know that even great companies go through periods of uncertainty, I don't feel any FOMO. I can take a step back and wait. And PayPal is a good example of this. Okay, everybody was chasing PayPal. It was all over the news around this time. No, I was patient, because sooner or later, even those companies go through these periods, either because it's a company-specific problem, or because of a macro economic of a macro headwind like a recession, it will cause the price to come back down. And in my opinion, we are at a stage now that it's the other way around, right? So now everything is moving substantially up except price, and I assume that gap will narrow over the short to medium term. To be fair, and if I show you this right here, this is Lulu, but let me change this to PayPal so I can show you guys exactly what I mean. If I change this here to PayPal, all right, so this we have earnings right here. Let me get rid of the P. Where is this? P. Yeah, we can just do it like this. In the case, this is PayPal, yeah. In the case of PayPal, what happens is that you can see, in fact, let me get rid of the price stock adjusted. So you can see what's happening is that you can see that the diluted earnings per share are going up, while price, in fact, it's going up since 2020, the end of 2000, since 2022. In fact, let me change this to the yearly charts. They have been going up under new management, while price has remained stagnant and really at low levels. Despite this being the highest earnings per share the company has reported going back to 2018. In fact, it's one of the highest ever. Look at this. Okay, it's actually the highest ever earnings per share. So the price is practically at its lowest point of all time, and earnings per share are at the highest point. I love this. So it's that disconnect that you try to exploit as a value investor, and then you just of course, because you know that sooner or later this will happen. All right, where is this? Right here. Based on history, you can see that earnings growth versus share price appreciation, those lines will tend to move in tandem over the very long term. Okay, and so yeah, so in this, by the way, is assuming the reality of earnings growth, which is 15%. But if you assume that the earnings growth, so if earnings growth, if even with earnings per share growth of 17%, which is the hypothetical scenario that I create here, yeah, a 17% growth, even if you end with a P/E ratio of 22, that would lead to a current price of about 160. And that, even with higher earnings per share growth, and with the 22 multiple, in the end, you would still be at break even. This is horrible, right? And again, it stresses the importance of paying attention to the valuation when you buy a company. All right. And the last example that I want to share with you guys, which is even more mind-boggling, is the case of another company in my portfolio, that is Lululemon. So where is this? Let me see. Right here that I created for you, because Lululemon, over the last 6 years from 2019 to now, has compounded earnings per share at 26%. That's crazy. However, look what happened back in 2019. The highest price point was around 234, and earnings per share were 3.61, and that led to a P/E ratio of 54. In 2021, at the peak of the euphoria, Lululemon got to a price as high as 457 and a P/E of 68. Anyway, and even more so recently in 2024, 510, that led to a P/E of 66. Okay, slightly lower, of course, than the crazy the P/E valuations we had here. But what happens is, even against the backdrop of 26% earnings per share growth, yeah, even if we assume a current P/E of say 17, Okay, that's already a bit higher, but even if we put like a 16 P, 16 multiple, you are practically at break even. So the P would have to be around 70 today for you to make a dismal return, by the way, because this from 234 to 248, this would have been a terrible investment. All right, because you paid a really high multiple. For this to be like an attractive investment at all, the PE either earnings would have to grow even faster, which is crazy because it's already 26% growth, or the PE would have to be like at 30, something like this. Okay, yeah, and even if you do that, you can see that the earnings that you would be. So how much is that compounded? Let's use our Kager calculator right here. So the starting value would be 235, give or take. The ending value would be 439 over that 6-year period. So that would be only 11%. And if you know me, you know that this doesn't make the cut. Even at 10%, you might as well, no, I mean, this is not for me. You might as well put your money in the index fund and wait for the very long term. Because I'll be right. I mean, why bother doing fundamental analysis for each individual stock if you are just getting 10% per year? That's why my minimum acceptable rate of return would always be 15% per year. That means you are doubling money every 4 to 5 years. And that, even with a PE of 30 and 26% earnings per share growth, wouldn't deliver on my expectations. Okay, this is not good. And so, yeah, on the other hand, right now, we have a P that is ridiculous, a P of 12. And look what happens if we use the chart. So let's put here Lululemon. And now what we will do, so we have diluted earnings per share. Let's put here, in fact, let's remove this and let's use net income. I want to show you guys this. And now let's use price, stock price adjusted. Look how cool that is. What you can see right here is that net income has exploded, continues to go up. He only started to decline ever so slightly around this level. So right now it was at 1.8 billion, 1.8 billion, 1.8 billion, but there has been in fact 1.79, 1.81. So it's just a minor decline, but look what price did, right? It crashed all the way to the ridiculous 173 that we find ourselves in right now. So price is coming down while earnings are improving. I like that a lot. Okay, it means there is a disconnect between the company's fundamentals and the market perception of its value, and I intend to exploit that. Okay, because sooner or later, just like you saw a mismatch on like the other way around, I expect that to happen as well. Okay, and that will allow us to make a lot of money, and of course that's what I've been doing with each of these positions, and it's been working out. It's been playing out very well for the portfolio, and I do expect that to continue. So look. This is what I wanted to do here, and I do expect that you guys managed to learn again, that you find the content, that you continue to find the content useful, and yeah, I can't wait to put out the other video. And if you have any preference in terms of which content I put out, leave comments, and I'm more than glad to make that reality. Okay, smash the like button if you like it, of course, and don't forget to share with people who typically FOMO, right? Because I myself have made many mistakes in the past, and in fact I help people exactly to control those emotions, because you can be very successful in the stock market just by keeping your emotions in check. And part of what I do is exactly to provide accountability, and to make sure that you are making decisions based on fundamentals as opposed to emotions, which is always a recipe for disaster. So if you like the content, smash the like button, and just share it with your own audience. And thank you so much for all the help that you've provided so far. It really means a lot. Thank you, guys.